Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm Mark Bunting, the host of RCTV. Thank you very much for being with us today. If you have any questions, you can put them in the comments section. We will try to get to as many as we can. Toward the end of the show, we'll likely go about 30 minutes or so today. The topic, as you likely know, uranium, nuclear, and gold. And our guest has unique perspectives on both as he runs a couple of companies in those respective sectors. He is Amir Adnani, and we're going to bring him in now. President, CEO, Uranium Energy Corp, and the founder and co-chair at GoldMining, Inc. Thanks so much for joining us today, Amir. We appreciate it.
Hey, Mark, good to connect with you. Thanks for having me now.
Now, let's start broadly with your philosophies toward things, so to speak, because you have actively sought out in your career counter-cyclical, contrarian industries, and you work in contrarian and counter-cyclical industries, or at least have worked, and maybe not so contrarian now because the rest of the world seems to be catching up. But can you give us a sort of a snapshot of your company building philosophy and your investing philosophy?
Really just playing the long game, Mark. When you see large global megatrends that are that you can really build high conviction around, it's difficult not to get excited, and it's difficult not to sustain that excitement. And in fact, you get more excited when you encounter downturns, because those downturns is when, as you point out, you can act in a counter-cyclical fashion. And really, in our business, when we talk about a hard asset business, valuations really go up and down, just in line with sentiment and just in line with those cycles that we experience. And so when I look at the uranium markets for the last 20 years, it seems like we've had cumulative 18 bad years and cumulative 2 good years, which is unusual because in the hard asset business, you're supposed to have 2 good years for every 3 bad years. So it's been really a wonderful example of a situation where you can see and you can tell that long-term energy demand globally for clean baseload electricity was not just not going away, but it's only going to grow significantly. And that if you can stick with that theme and keep building business case around it and a business opportunity around it, you can play the long-term game, then eventually it will work out. It's quite similar to gold as well as a currency, the only currency that's not being sort of diluted away the way fiat currencies are. You just know long-term with the way government finances are going, the way fiscal policy is going, the way trade is going, that gold on a long-term basis is going to significantly benefit from that. So both yellow metals, uranium and gold, one's really a currency. The other one is really truly an energy commodity. Very different applications and cases for both of them. But I think the long-term kind of megatrends around both of them are what attract me to these cases as an entrepreneur.
We'll get back to gold. Amir, let's stick with uranium and nuclear. You've said, and many people talk to heads of companies, they're saying that, like Corey Bellick, for example, Canalaska Uranium, these are the best fundamentals you've ever seen in your career in the sector. And as you point out, there was a big, long, torturous bear market of about 11 years. So the uranium sector coming out of that There are a lot of tailwinds which have been detailed many times in the sector, but which are the key ones that you focus on that you really think are driving things right now and will continue to drive?
It really has to start with the supply-demand profile. I mean, for every commodity, that's where you want to start. And to me, when you look at that, you see global production, primary supply is only really satisfying about 75% of demand. That underscores the reason why why we have higher prices. That's going to continue to be the case moving forward. Supply side response is going to be challenged by just the sheer nature of the mining business. It takes a long time to permit and build new uranium mines that are needed to really help balance the market that we see here. So the primary building block here is really supply demand. On top of that, there are, I think, secondary drivers, be it geopolitical, be it new demand applications like AI-driven data center growth, et cetera. So when you kind of get those situations that then further exacerbate geopolitically, that's exacerbating the supply side, availability, demand for data centers is exacerbating and kind of making the demand case even stronger. That starts to really kind of stretch and improve the supply demand scenario. But that's really gravy on top. I think for as long as we see a scenario where supply is at a physical imbalance to demand, you know that you've got a very compelling opportunity here. And all the tailwinds that everyone here, I think, is familiar with is what really makes this setup. You hear people say the best setup ever for uranium. It's true. But I think at the heart of it, the key building block, again, is really this physical supply imbalance versus existing demand for reactor requirements.
Amir, the United States was the clear global leader in the 1970s and 80s in the nuclear sector. And then we had 3 Mile Island, you had Chernobyl, you had Fukushima in 2011. So sentiment clearly shifted. And now it's shifting back the other way. And the U.S. wants to be a leader once again. And we're seeing a shift from east to west to a degree. So you've got boots on the ground. You're very familiar with the U.S. Territory and landscape in terms of the nuclear sector. What do you think and what do you make of the effort now that the U.S. is making a concerted effort to be a leader again?
We have to sort of look at the demarcation line as the end of the Cold War. Prior to the end of the Cold War, there was more self-sufficiency in Western markets led by the U.S. when it came to nuclear fuel supply chain. And as you pointed out correctly, the U.S. led the way in global uranium mining. With the end of the Cold War and the signing of the highly enriched uranium treaty, the U.S. strategic objective was to see the dismantling of Soviet-era warheads, where highly enriched uranium was blended down to low-enriched uranium and sold into the Western market. So we had to make room in the Western markets for that Russian supply, which went on for about 20 years under that treaty, which was the equivalent of the world's largest uranium mine. If we look at it as a secondary supply, it was close to 20 million pounds of uranium a year. But it came at a price, and the price was the domestic industry, the Western markets really shrunk as a result of that, or in the case of the US, disappeared. And the US became heavily dependent on Russian imports of low-enriched uranium. This program ended in 2014. The market remained oversupplied because of the Japanese inventories caused by Fukushima for another decade after that. And then came the Russian invasion of Ukraine. We must remember, prior to the invasion of Ukraine by Russia, which made really the idea of depending on Russia for energy commodities intolerable, there were actions taken, in fact, during the first Trump presidency, to identify the vulnerability that there existed in the US on foreign imports of uranium, namely from Russia. And that's when President Trump initially had created the White House Nuclear Fuel Working Group, whose works and recommendations ultimately led to the creation of the Strategic Uranium Reserve, the ban on Russian uranium imports, all of which were executed during the Biden administration, which speaks to the bipartisan support that we see in uranium today. And it speaks to the fact that today, there is this bipartisan support to see a rebuild of a domestic nuclear fuel cycle in the US, to repatriate the nuclear fuel cycle and to onshore what was previously offshore. This is due for, again, a variety of reasons. When you see the need for HALEU, high assay low enriched uranium, this requires an increasing amount of US origin uranium. That means uranium that's produced from US soil. It also means, again, supply side resiliency, the idea of depending on imports for any vital goods, be it pharmaceuticals or be it uranium, is something that we think more about, and local supply chains, especially strategic ones that support energy and infrastructure, are seen as critical. And so we have this pre-Cold War era, we have this post-Cold War era, and now we have a new era, which looks and potentially resembles a lot of what happened before the Cold War. So what we see is absolute unanimous and well-supported bipartisan policy in the US that looks to create a groundwork for the rebirth and regrowth of uranium mining in the US to go back to its previous highs, conversion, enrichment as well. This is the strategic uranium reserve that was created, the ban on Russian uranium imports, the funding that it unlocked out of the Nuclear Fuel Security Act, that Advanced Act to reduce the red tape and regulation to build and permit new reactors, an incredible number of successful legislative outcomes that we've experienced over the last few years, going back to the Trump administration, followed on by the Biden administration, and now expected to be continued and even amplified with a very pro-business, pro-energy, pro-nuclear Trump administration coming back.
Amir, that was an excellent history lesson. Thank you for that context and perspective on the United States and what's been going on over the years right up to today. I want to get back to artificial intelligence and the data centers needed to run those programs and the power needed as well. How would you call it the gravy on the top? It is sort of an added pillar. It's a nice bonus for the sector. But is there any danger that there's so much hype about AI that maybe you can poke some holes in this story, and that some of this hype about nuclear related to data centers may be a little overblown?
I mean, honestly, and to be fair, I don't see really hype in the uranium market as a result of the AI interest and AI being linked to nuclear power. And case in point, the uranium price. The uranium price was around $80 a pound when the first major announcement came on September 20th between Microsoft and Constellation for the restart of 3 Mile Island Unit 1. And it's still around $80 a pound 60 days later. And in those 60 days, we've seen announcements by Amazon and Google, Oracle into nuclear energy for the first time, and ongoing and continued enthusiasm from big tech into nuclear. So I don't see a lot of hype here. I think it's actually, if anything, we're seeing a lagging effect in terms of the move in uranium, given that we have basically a whole new paradigm of demand here when you think about what it means to have big tech enter the arena. And I would say it's definitely a game changer, because when Microsoft signs a premium power purchase contract for 20 years with Constellation, and that premium is above and beyond what the previous market rates where Constellation was getting otherwise, that puts the end user in a financially strong position, such that if a year ago fuel costs, including uranium, was less than 2% of their operating costs, with a premium 20-year contract with Microsoft, fuel cost is now less than 1% of total operating costs. It's negligible. And so that means this, any potential ceiling you thought we had on uranium prices has just basically just moved up. And it's just moved up because the end user is in such a different, never seen before financial position. Remember, these are utilities, some of whom were previously competing in deregulated electricity markets, competing against subsidized wind and solar. They were getting killed. In some cases, we forget now, some reactors that Exelon used to have in Illinois were constantly on the brink of potentially being shut down because they couldn't compete in those deregulated markets. So this is a whole new landscape. This is definitely a game changer to see the demand come in from big tech to provide the financial assurance, certainty, and premium kind of pricing towards these utilities. That's why these utilities are not, even when you look at the share prices of Constellation and Vistra, some of the other players in those markets, they're not trading anymore like utility companies. They're moving up like they're growth stocks. And this is unusual. We haven't seen this in a long time. This is the best situation as uranium companies we could have asked for, whereby it's not strictly government policy or tariffs or restrictions that drive interest and demand in uranium, but it's real demand driven by some of the biggest companies on the planet who are showing up at the doorsteps of our customers, and our customers hopefully then subsequently having to show up at our doorsteps to make sure that the multi-decade new demand for uranium and nuclear power that's being created here has the legs and the necessary fuel to continue on with. I think we've only seen the tip of the iceberg here, because the demand for energy from these data centers is measured in many, many gigawatts. And all we've seen in the last 60 days is maybe a total of less than 1 gigawatt of power between the various announcements that's actually been secured. So much more has to happen still if the AI-driven energy demands are to be satisfied. And we're no longer talking about small reactors anymore, as much as that's another topic I know you want to talk about. We're talking about large reactors. Even Elon Musk the other day tweeted, we need larger reactors. Reactors need to be larger. And that speaks to the fact that demand for electricity is in the gigawatts, not megawatts. And that's a very positive shift. And a new layer of demand on top of the existing demand that was out there. And that's the 20% of power that the nuclear fleet currently provides in the US alone.
Let's stick with small modular reactors, SMRs, that you refer to. A lot of talk about that technology. How soon before we see a number of them in operation? Are we getting towards maybe the end of the decade to see that, or perhaps sooner?
Well, I think we have to remember that SMRs are not currently projected in demand models when people talk about supply demand for uranium. So again, it's just another new layer of demand not currently accounted for. And I think it's going to be one of those inflection points where once you get a few of these SMR prototypes up and running, then you're going to see an acceleration because of the way these are manufactured and then just installed at site. They don't have the same construction lead time that larger units would have had historically. So I think while we might be a number of years away from that point, when that point comes, you're going to see fast adoption and fast deployment, and the upfront fuel requirements, given the high enrichment levels of HALEU fuel type, means that multiples of initial uranium needs for the initial load cycles are going to be needed. So I think it's fascinating to think about how little we actually account in supply demand models for the emergence of SMRs, yet once they get going, they could nearly double existing generating capacity. In fact, that's the estimate that the Nuclear Energy Institute has given, whereby they think by 2040, nuclear generating capacity in the US, for example, could double strictly from the deployment of SMRs. Now, we know that won't be the case because we know there's going to be large reactors built as well, given the recent announcements that we've seen. And we're going to see reversal of previously retired reactors, and we're going to see uprates. So we're going to see all these other forms of demand pickup, but SMRs, again, come in even on top of that. So it's a very bullish setup, and we're a number of years away from the eventual outcome. But in the world of uranium demand and nuclear power, that's actually how demand is measured. Demand is measured a few years out. No one is buying uranium for their needs next weekend. And so when you think about that, most reactors are covered for the next 2 to 3 years of their requirements. A few years out is actually the sweet spot of where new SMR demand could be, in fact, competing for the reactor requirements of uranium of the existing fleet.
Amir, let's get to one of the companies that you run, Uranium Energy Corp, which is nicely positioned with three hub and spoke platforms in Wyoming to supply this demand for uranium in the nuclear sector. Can you give us just a brief overview of some of the latest developments, such as that the latest deal to add that third platform with that arrangement with Rio Tinto?
Yeah, we've continued to grow the business through acquisitions and organic developments over the last decade. In the last 3 to 4 years alone, we've done over $1 billion of acquisitions. And with UEC as a US company, all figures are in US dollars. The acquisition of Uranium One back in 2021 is important to touch on because it sort of connects back to the acquisition of our transaction here with Rio Tinto of the Sweetwater assets. Uranium One had the largest uranium mining operation in the US. It was all owned by the Russian government. Before the invasion of Ukraine, they decided to sell. Of course, none of us as buyers that looked to buy had any idea what the Russians were planning, but it became apparent in hindsight why they were exiting. And it became a very timely acquisition for UEC to acquire the Uranium One business. That Uranium One business came with assets in the Powder River Basin, a processing plant and permitted mines that we have restarted with production that's currently ramping up in the Powder River Basin. But it also came with a suite of assets in the Great Divide Basin of Wyoming, where there were large resources, historic, but no permitted plant and infrastructure to develop a production strategy around it. The second biggest holder of uranium assets in the United States, Rio Tinto, had exclusively these holdings in the Great Divide Basin with a plant called Sweetwater. And after many years of deliberation as to whether they're going to hold or sell these very key strategic assets, they decided they were going to sell as part of Rio Tinto's overall strategy to exit uranium as they become more concentrated on iron ore, copper, and lithium. So it was an opportunity for us to pick up this latest kind of package, and it was a very competitive situation given the rising interest in uranium. But we got lucky because we managed to really close this, announce the deal, and sign it before the last 60 days of activity that we've seen in the market, which includes not only the big tech move into nuclear energy, but also last week's news of the Russian curb on exports of uranium and low-enriched uranium to the US. So you can appreciate there's definitely been a step change in valuation for US assets just in the last 60 days. But fortunately, we were able to really price this deal and lock it in before that happened. And in essence, we're paying $175 million from cash on hand for 175 million pounds of resource in the ground, plus a 4 million pound per year plant at Sweetwater. So we think it's an exceptional deal, win-win situation for us and Rio Tinto. It's the second transaction we've done with Rio Tinto in the last 3 years. 3 years ago, we paid $150 million for the world-class Rough Rider deposit in Eastern Athabasca Basin. And we had a recent development there as well, where we announced the first economic study on Rough Rider, showing that this is by far one of the best development projects in Canada, with the lowest capex requirement, with 40% IRR using the $80 uranium price, with crystallized the post-tax NPV of almost $1 billion, the same asset that 3 years ago we paid $150 million for. If uranium prices go to $140, $150 a pound, which we think is a question of when, not if, the NPV doubles to $2 billion and so on and so forth. And as an unhedged company with no price ceilings in any contracts that we've signed, we stand to capture every bit of that upside that we see in the uranium price. So we've been very aggressively growing the company and the business. We'll have, after we complete all of our SK 1300 resource reports from the Rio Tinto acquisition, over 500 million pounds of uranium resource in the ground in all categories. That makes us the second largest holder of uranium in North America after Cameco only, but the largest by far in the US, both in terms of resource, but also in terms of total license capacity, with 3 processing plants in Wyoming and Texas and 12 million pounds of annual production. The life of mine of our Rough Rider deposit came in at just under 7 million pounds per year. So that would be on top of our 12 million pounds of license capacity in the US, with a projected all-in cost of $20 per pound. So truly showing world-class margins and demonstrating that Rough Rider is a world-class project. So moving forward, you've got multiple fronts that UEC will be advancing, with production ramping up in the Powder River Basin, looking to develop a second leg of production growth in South Texas for 2025, advancing the newly acquired portfolio of assets from Rio Tinto in Wyoming, and continuing to advance the Rough Rider project. Next step is pre-feasibility study, additional permitting work, and an upgraded resource estimate based on the 90 holes we drilled year to date, and some very strong results that we've already delivered, and some new areas of growth and new discoveries that we've made, which we think will help increase the overall size of the resource as well. So there's never a dull day or a dull moment at UEC. We've got lots of irons in the fire. It's a company that's 20 years in the making, and definitely positioned as the leading North American company with no debt, no contracts that provide for those limited upside on the price. We're unhedged, unlevered, and advancing rapidly with production growth.
And you're being modest. The stock has done incredibly well over time. Now, Amir, we've got about 5 minutes left. We've got you talking gold as well. So let's switch over, and I'm going to try to save a bit of time here by combining a couple of questions. But more so, we'd like to know about GoldMining, the 14 assets that the company has in 5 different countries in the Americas. And these are assets that you've said over the years you picked up for maybe 10 cents on the dollar, and that strategy has really paid off. So what does the strategy turn into now in terms of maybe trying to unlock some of the value, maybe sell off some assets? Is that the environment you're in now, or not necessarily?
100%, Mark. And at a macro level, I think the drivers of higher gold price between U.S. government with Trump presidency introducing tariffs, which will be very inflationary, combined with ongoing rate cuts by the Fed, combined with central bank buying of gold throughout the world, and unfortunately geopolitical issues that continue to persist throughout the world in the Middle East and with Ukraine. Gold should certainly, at a minimum, get to the $3,000 an ounce level, which is what now, over the last 24 hours, UBS, Goldman, and other banks are calling for. But I think, with the setup that we have now and with this Trump presidency being very inflationary, there's no doubt that we're going to see gold surpass 3,000 and march even higher. You're kind of seeing that in the Bitcoin price as well, Bitcoin approaching almost $100,000 here. So gold, in fact, if anything, is lagging right now. With respect to gold mining, we've not only amassed over 22 million ounces of gold in the ground, acquired it for cents on the dollar, but since bringing over Alistair Still from Newmont, where he was in corporate development, head of corporate development, to become CEO of GoldMining, we've really embarked on this next phase of GoldMining's value creation, which is unlocking the portfolio, the value of the portfolio that we bought for very cheap when gold prices were $1,200, $1,300 an ounce. We've already shown the first example of that. We spun out a project called Whistler that we had bought for $2 million in 2015. We spun that out at a pre-money valuation of $100 million. And now that's a listed company, ticker symbol USGO, advancing that project and advancing basically what is a 10 million ounce deposit. The other 22 million ounces that GoldMining owns 100% have that type of potential, whereas we continue to unpack the portfolio, and Alistair, with that background he has from having done similar kind of work at Newmont and Gold Corp, we've got the leadership in place to be able to really execute on this next phase of growth at GoldMining. The company has over $150 million of cash and liquid assets in terms of listed equities. The enterprise value for 22 million ounces of gold in the ground is very cheap. I think it's less than $5 an ounce as of this morning, maybe even less. That's kind of crazy. We're putting our money where our mouth is. I've recently been buying stock in GoldMining. You can see that. And I've done the same at UEC. So both UEC and GoldMining are long-term projects and holdings of mine. And you've seen me never sell a single share, but always regularly add to the position. So, and same with Alistair, the CEO of that company, and where I'm the founder and co-chairman. So I think it's got tremendous optionality to the price of gold. And if you can pick up exposure to gold in the ground right now for less than $5 an ounce in the ground, that's pretty compelling. And I think with next year, gold prices moving higher, gold miners getting a re-rate, this company is extremely well positioned to do well in that situation.
Amir, we have people watching from all over the world. Sweden, we've got Arizona, I saw Brazil, Chile, and many other areas. I'm going to take one question here before we wrap it up. It's Terry Papineau, back to uranium. He'd like to put a little flesh on the bones in terms of supply contracts, how many pounds are contracted, how many years, current discussions. Can you shed any light on that?
Yeah, it's good to hear from Terry. He's a veteran of uranium investing, and as he knows very well, UEC has the very unique strategy of being unhedged, and it's what that means is that we sell uranium. In fact, we've sold 4 million pounds of uranium in the last couple of years, but we index to the spot market, and we do have contracts, but our contracts are spot market linked. So we certainly have our future production needs and profile covered in terms of where we plan to sell. But again, unlike Cameco and others who have $70 ceilings and their contract booked to the end of the decade, we want to capture every bit of upside, right? So if uranium goes to $140 tomorrow, many of the companies that have signed contracts will be capped at $70, $80, some $60 per pound. To me, that's just leaving too much on the table. But what UEC is designed to do is to capture the market, the best pricing at any given day. Uranium goes to 150, we capture 150. It goes to $200 a pound, we capture $200 a pound. And that's due to the fact that we have a debt-free company. We're the only debt-free uranium producer out there. And so that gives us financial flexibility to be able to be a spot link company. And of course, with all the enthusiasm and the supply-demand imbalance, our view is why not? Why not have every bit of upside exposure as possible?
All right, Amir, I know you've got a fairly hard out. Any final thoughts on either uranium or gold for investors to ponder as they to take away from this conversation?
I think 2025 is going to be a banner year for both yellow metals. I think we're going to see triple-digit uranium prices. I think we're going to see over $3,000 an ounce gold. I think going into 2025, I can't think of a better time and setup for both commodities for different reasons, but both, I think, really going into the best of what they still have to offer in 2025.
Amir, thanks so much for your time today. We really appreciate it. Great insights from you on both the uranium and gold sectors. We hope to do it again. Thanks again.
Thank you, Mark.
All right. How about that, Amir Adnani? Our thanks to him. Thanks to you for watching. As I said, he had a fairly hard out. We would have kept going with a few of your questions, but perhaps next time when we have him back. Thanks a lot for watching. Watch the replay on Red Cloud's YouTube channel if you missed any of this, and we'll see you next time. Take care.